Have you ever tapped your phone for a payment and had that weird, fleeting thought like, is my money doing something or the secret conga line in the cloud?
Or maybe, is this digital dollar even really mine anymore?
Exactly. Welcome, everyone, to the deep dive. We're here to plunge into the vital, often complex information out there, helping you cut through all the noise. Today, we're taking a really fascinating journey into digital finance. We're pulling insights from the Joel 2025 Consumers 360 News Commentary.
That's the aggregator from consumers.app, right? From just a couple of days ago, July 20th.
That's the one. And our mission today is to unpack these big stories, what they actually mean for your wallet, your privacy, and, well, the whole future of how we deal with money. So let's dive straight in. The sheer scale of digital payments is it's mind-boggling, especially in some of these fast-growing economies. Our first headline really sets the scene. It's from the Times of India. UPI surge. India leads the world in fast payments. 18 billion monthly transactions power growth.
It is remarkable, isn't it? The speed, the volume. It's truly unprecedented. UPI, that's the Unified Payments Interface.
Right.
It's India's own instant payment system, launched back in 2016 by the National Payments Corporation of India. And it basically lets people make seamless interbank payments, peer-to-peer, P2P.
Like sending money to a friend.
Exactly. Or person-to-merchant, P2M payments, all just using their mobile phones. And its global impact is huge. By 2022, UPI was already handling something like 46% of all global instant payment transactions.
46%. Wow.
Yeah. And just this past May 2025, it processed nearly 19 billion transactions.
Billion with a B.
Billion with a B.
Yeah.
Worth almost USD 300 billion. It's a massive engine processing real-time money flow.
Okay, that scale is incredible. But let's unpack this a bit.
Yeah.
How does something that convenient actually change our personal spending? Yours and mine.
Oh, it absolutely does. There was research looking right into this, the impact of UPI on spending habits. And it found something really interesting. About 75% of people surveyed said they actually spend more because of UPI.
More. Why is that?
Well, it seems to boil down to two things. Sheer convenience, obviously, but also the intangible nature of digital money. When you're not physically handing over cash, that little bit of friction, maybe even a tiny bit of guilt, it kind of disappears.
Yeah, that makes sense. The pain of paying is less.
Precisely. The seamless process just encourages more frequent, almost effortless spending. So moving from cash to cashless isn't just about convenience or security. It can genuinely rewire how we perceive money and how easily we part with it.
Okay, so it hits our wallets directly. But let's zoom out. Billions of transactions happening in real time. What does that massive flow of data mean for, say, the bigger economic picture, for policymakers?
This is where it gets really powerful. This kind of high-frequency data gives incredibly granular economic insights. They're crucial for effective policymaking. There was a UK study, for instance, analyzing business payments from 2015 to 2023.
Okay.
And it found really strong correlations between those real-time payment flows and GDP, matched up neatly with established economic indicators.
So it's like taking the economy's pulse in real time.
Exactly. It shows the immense value of this high-frequency data. You get a much more detailed, up-to-the-minute view compared to the traditional indicators, which often lag behind. It allows for much more agile and informed policy decisions.
And what's the tech underneath all this, making it work, keeping it secure?
Well, a lot of it relies on token-based payment systems. These are really important for boosting both consumer privacy and accountability. They use digital tokens, often on distributed ledgers, think blockchain-like tech, to process transactions securely and privately. And people are even working on challenges like offline payments for digital currencies, like systems designed for the digital euro, making sure they're secure and private, even if your phone's offline or compromised. And looking even further out, there are concepts for fully decentralized digital currencies, things designed to replace physical cash with like a peer-to-peer setup that's secure, direct, and aims for stable value, unlike, some of the more volatile stuff out there.
Okay, so the tech is evolving fast. But that brings us to the next big challenge, right? Regulation, especially in the crypto world. As money gets faster and more digital, how do we keep it safe and properly regulated? This leads us straight to stablecoins. Our next headline, this one's from Times Now on MSN.com, puts it bluntly. Stablecoins face U.S. clampdown. What the GENIUSAct means for cryptos, $260 billion cornerstone.
Yeah, that's a big one. It really shows how regulators are scrambling or maybe strategically moving to catch up with financial innovation. The GENIUSAct, that stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act.
Okay.
Yeah, it's a U.S. federal law trying to build a comprehensive regulatory box around stablecoins. The core idea is that stablecoins must be fully backed, one for one, usually by U.S. dollars or other really low-risk liquid assets.
So real money behind the digital coin.
Exactly. It mandates strict standards for reserves, requires regular audits, demands transparency, and it sets up this dual supervision structure, both federal and state regulators involved.
Which should mean more consumer protection.
That's the goal. A much stronger layer of security and oversight for the stablecoin market.
Okay, sounds pretty significant, but maybe step back for a second. For someone listening who isn't deep into crypto, what makes a stablecoin different from Bitcoin? Why are they getting this specific regulatory focus?
That's a really important distinction. Unlike Bitcoin or Ethereum, which can have wild price swings based on market sentiment.
Very wild.
Right. Stablecoins are designed to hold a stable value. They do this by pegging their worth to some reference asset. Most commonly, it's a fiat currency like the US dollar, but it could also be commodities.
But is that stability guaranteed, or is it more like an ambition?
That's the key point. The stability isn't inherent. It's something that has to be actively maintained. It relies heavily on market confidence and, crucially, on the issuer having enough reserves and liquidity to back the peg. There are different types. Fiat-backed are the most common, but you also have crypto-collateralized and algorithmic ones.
Mm-hmm.
Each tries to maintain stability differently, often with complex risk trade-offs.
Okay, I see.
And their role in the crypto world is huge. They provide that stable medium for transactions, right?
Yeah.
Letting people move value without being exposed to the crazy volatility of other coins. This stability is really key for wider adoption, for bridging crypto with traditional finance. That's why their market cap has exploded over, USD 246 billion by May 2025?
Wow.
Yeah, so their growing size and importance makes them a natural focus for regulators wanting to manage systemic risk.
Right, they're becoming too big to ignore, essentially. So they're the anchor, and regulating them is crucial for broader trust. And speaking of broader trust and use, let's widen the lens to crypto adoption overall. Our third headline, this one's from Forbes, asks the question directly. What is crypto adoption, and is it increasing? Examining global growth in 2025.
So crypto adoption is basically the process of these digital currencies, Bitcoin, Ethereum, others, getting woven into the fabric of our economic systems, using them for payments, as investment assets, sometimes even as legal tender, like we've seen in a couple of places.
And is it actually increasing? What do the numbers say?
Definitely increasing. The global crypto market cap hit around $2.76 trillion back in April 2025. That's a pretty clear signal of growth and wider acceptance.
What's driving that growth?
It's a mix of things. Ongoing tech improvements in blockchain itself, definitely more institutional investors getting involved.
Big money moving in.
Right. Plus growing interest from regular consumers in things like DeFi, decentralized finance, which promises more individual control. And importantly, clearer rules are helping. Regulation isn't just a clampdown. Sometimes it provides the clarity needed for growth.
Like MiCA in Europe.
Exactly. The EU's markets in CryptoAssets regulation, MiCA, it became fully applicable late last year, December 2024. MiCA is a huge step for the EU. It creates a standardized framework, makes transactions safer and more transparent. That really boosts investor confidence, which fuels more adoption.
But it's not all smooth sailing, right? What about the risks security?
Oh, definitely not smooth sailing. Security is a massive ongoing challenge. There's a recent academic study, Wallet Probe, that identified like 13 different ways attackers could target browser-based crypto wallets. Yeah, 21 specific attack strategies. It just highlights how urgent the need is for better security measures to protect people's funds. We're also seeing interesting developments like privacy-preserving cryptocurrencies, trying to balance transparency with user privacy, and concepts like Rwanda coin being explored for things like intercountry trade in Africa. Plus global efforts like CRF, the Crypto Asset Reporting Framework, aiming to improve tax compliance by getting countries to share information automatically.
Okay, so adoption is up, regulation is trying to keep pace, security is a major focus. It feels like this is bleeding into traditional finance now, which leads us perfectly to how these digital ideas are reshaping traditional investment. It's not just about buying crypto anymore. Our next headline from USA Today gets right into it. Here's how tokenized stocks are revolutionizing investment access.
Right, tokenized stocks. So basically, you take a traditional stock like Apple or Tesla and create a digital representation of it on a blockchain, a digital token that represents ownership.
Okay, so it's like a digital twin of the stock.
Kind of, yeah. And the big deal is how you can trade it. These tokens often allow for fractional ownership, buying just a small slice of an expensive share.
So you don't need hundreds or thousands of dollars to buy one share of some companies.
Exactly. And they can often be traded 24/7 on digital platforms outside traditional market hours. They also might operate under slightly different, sometimes less stringent regulations than normal securities.
What's really fascinating here, though, how has a platform like Robinhood getting into tokenized stocks really changed things for the everyday investor, for you listening right now?
It's been a huge catalyst. Robinhood really leaned into democratizing access. Allowing fractional shares dramatically lowers the barrier to entry for retail investors.
Makes it easier for anyone to start investing.
Precisely. And beyond just affordability, think about the potential for global liquidity. Trading 24/7 instantly divisible assets. You could create truly global, continuous markets. The upsides are pretty clear. More access, potentially better liquidity, maybe lower transaction costs because you're using efficient blockchain tech.
But there must be downsides too. Risks.
Oh, absolutely. It's still a pretty new market. Regulatory uncertainty is a big one. How will governments ultimately treat these things? There's potential for high volatility, maybe even more than the underlying stock. Security is always a concern with digital assets. And, of course, the potential for fraud in a less regulated space.
It's also interesting how other tech is intersecting here. Like AI large language models are getting better at analyzing financial news to predict stock returns. And researchers are using complex analysis to see how the price patterns of tokenized stocks differ from cryptocurrencies. It's all evolving very fast.
So individuals are getting new ways to invest. What about the big players? How are major companies starting to use crypto not just as something to trade, but as part of their core financial strategy? Our final headline, this one also from Forbes, looks at exactly that. From Bitcoin to Ethereum, the rise of CryptoTreasury strategies.
Yeah, more companies are definitely starting to hold cryptocurrencies like Bitcoin and Ethereum directly on their balance sheets in their corporate treasuries. Why would they do that? Isn't it risky?
It definitely carries risk, but the strategic thinking is often about hedging. Using it as a hedge against inflation or currency devaluation, especially in uncertain economic times. Plus, there's the potential for the asset itself to appreciate in value. Companies like MicroStrategy have been famously bullish on this, and others like SharpLink are exploring it too, diversifying their treasury holdings.
Is there a difference in why a company might hold Bitcoin versus Ethereum in its treasury?
Yes, potentially a significant one. Bitcoin is largely seen as that digital gold, primarily a store of value, a hedge.
Right.
Ethereum, while also volatile, has this whole other layer of utility because its blockchain supports smart contracts and decentralized applications, or dApps.
So it's not just holding an asset, it's holding something you could potentially use.
Exactly. Businesses could leverage the Ethereum network itself for innovation, streamlining operations, building new services, engaging with DeFi protocols. It offers more potential utility beyond just hoping the price goes up.
But the challenges must be immense for a company doing this.
Huge. Regulatory uncertainty is still a major headache globally. The market volatility is obviously a massive risk for a corporate treasury that needs stability.
You can't have your operating cash swinging wildly in value.
Precisely. And cybersecurity is paramount. Protecting millions or billions in digital assets requires incredibly robust security measures. So yeah, crypto volatility is definitely a double-edged sword for corporations. Big potential upside, but also substantial risk. It requires a very careful strategic approach, maybe using hedging strategies or strictly limiting how much exposure they take on.
And wow, there we have it. A pretty intense deep dive into this huge shift in finance, from UPI revolutionizing payments in India to the U.S. trying to regulate stablecoins with the GENIUSAct, crypto adoption marching forward globally, and now tokenized stocks and even corporate treasuries getting into crypto. It's a lot. We really hope this conversation helped you cut through some of that complexity and feel a bit more grounded in how money itself is changing all around us.
Absolutely. And remember, understanding this stuff is key. In such a fast-moving space, thinking critically about the information you get is just, well, it's essential.
Couldn't agree more. Thank you so much for joining us for the dive into the evolving world of digital finance. And maybe leave you with this thought to chew on. As our money becomes ever more digital, faster, instantly transferable across the globe, how might our fundamental idea of ownership change in the years ahead? What will it mean to own something in that future?